Okay, thank you everybody for coming out to Runway Dinners hosted by First Republic Bank tonight. And we have an awesome panel for you about early stage fundraising. So without further ado, I'm going to hand the mic over to MK from FRB, and we'll get started.
Oh, great.
Who has a mic?
Thanks everyone for coming out tonight. So we're just going to get started and go down, and I'm going to have all the panelists introduce themselves. We have a diverse panel here with some investors, some people working on different types of investment platforms, and a few founders who have recently closed some rounds, so they're right there in the trenches with you and can kind of provide that perspective. So, and I'm MK Hurlbut with First Republic Bank, Director of Tech Outreach there, and we work closely with Runway to try and provide educational content like this for all of you. And this is going to be a really open discussion, so feel free to raise your hand, pipe up when you have questions. If anything we're talking about doesn't seem clear, let us know, because this is all for you guys. So we'll start right here with Catherine.
Hey, is this thing on? Yes, all right. Yeah, I'm Catherine Anderson. Former resident here at Runway. And so my company is called Assemblage, and we do real-time collaboration stuff, like webinars, screen sharing, web conferencing, without downloads, plugins, and installations. And we recently raised our seed round.
I'm Kevin. I am one of the head engineers at AngelList, which is a platform for early stage fundraising. So I'm not currently in a fundraising startup, but I see lots of them. So I'll help out a little bit.
Chris Gottschalk, Bloomberg Capital, classic early stage venture firm, focused on leading seed and Series A rounds, so writing checks $500K to $5 million across full tech stacks, so everything from enterprise, infrastructure, storage, all the way to consumer.
Sam Heshmati. I'm actually focused on helping entrepreneurs at First Republic Bank, and also spend a lot of time working very closely with the venture community.
I'm Anthemos, the CEO and founder of Zumper, real estate platform. We just were in the trenches. We just raised our Series A 3 weeks ago.
Awesome, thank you guys. So I thought, also there's a hashtag in case you want to follow along and ask me questions from it, and it's hashtag FRB Tech Connect. So just go ahead and hit that and I'll see it. I thought the best place for us to start, maybe Sam and Chris, you guys are best suited to start with this, just to go over really quickly for everyone, like the basic economics that venture capitalists have to think about when they're making an investment, because I think a lot of times for entrepreneurs, they have this idea of how much they're supposed to raise and are expecting checks to be cut for them from certain firms or funds, but don't really understand the economics that you as an investor have to think about when you're trying to be strategic working with them.
Yeah, I think every investor is different based on their fund size, their check size, what they're looking for ownership. But I'd say, for folks going out raising a classic seed round, and I'll say classic seed round is anywhere from $750K to now probably $2 million, which you can probably define it better as first institutional capital. That's a better way to probably define your seed, but it'll be somewhere in that range. The folks who are leading that round are going to be in what they call the venture fairway, so looking anywhere from 15 to 30% of your company traditionally. If you're raising a much larger seed round, that percentage can go up. And the investors are really looking, anywhere from a 10x or a possible return on their entire fund for one company. That's the venture style return they're looking for. So you can call it an outlier by any means, because that risk reward trade-off has to be such that they can either see a 10x or return their entire fund with one investment. So that's kind of the high level unit economics.
Yeah, just to add on that point, I think a key thing to focus, whether it's at the seed stage, Series A, is simply understanding the size of the fund. If there's $1 billion fund, the idea whether or not you're a company that they would ever invest in. At the end of the day, one reason why we're all here is to help you guys all identify where you want to spend your time, right? Well, if you have a $1 billion fund that needs to essentially be able to potentially return the company on any given investment, you can kind of backdoor into your market size and everything, and based on the percentage of ownership by the time there is an exit by that given venture firm, assume they own 10%, 15%, how much value the company has to drive and how much enterprise value there needs to be there to return that fund. And if you can't backdoor into those numbers, you're probably not an investment they're looking to make.
And yeah, I'll add one thing. We raised our seed round from very small chunks of VC capital. So Andreessen, Kleiner, Greylock, NEA, they all put in somewhere between $100,000 to $300,000. And we ended up raising our Series A from Kleiner Perkins, and they put in 6.5 3 weeks ago. And so some funds have seen seed recently as a call option, where their economics, they're never going to have a crazy IRR on putting in $100,000, but it's kind of, to them, because their funds might be $2 billion, it's a way to build a relationship with an entrepreneur that they want to get to know at the Series A stage. And so sometimes from our perspective, we saw big kind of Sand Hill Road funds writing checks that didn't have potentially the intrinsic economics until they had the kind of opportunity to re-up at the Series A. I think that's changing. We raised our seed round in 2012. I think already a lot of the big funds have found that it's very hard to support a seed portfolio of kind of dozens of companies that all require re-upping. So I think there's a change going on there, but I think there are funds that do seed for intrinsic value, and then there are funds that potentially do seed somewhat as a call option to build a relationship with you, so that when you raise a Series A, you go to them, not to kind of X, Y, or Z.
That kind of brings up a good point. When we had a panel on fundraising like 6 months ago, I feel like we were talking about the Series A crunch and what does that mean, and there's all these seed investments and they're coming in at a super high valuation. And now, especially given what you were just saying, it feels like maybe there's like another new trend where everyone's backing off away from that a little bit. So maybe you guys can speak to, I know, Chris, you're at Bloomberg, and Sam, you work with a lot of those early stage funds as well, and the niche in the market that they're kind of building out compared to like a larger firm trying to make a seed investment.
Yeah, I think there's a few things there. One is what the large venture firms are finding is that seed is hard to scale. The economics are there that such that only one person can handle so many companies. So if you want to scale seed investing, it's not like scaling a software product. So in that sense, it's very capital inefficient. So you see some of the larger funds moving towards this call option model where here's $100K, don't talk to me until you're ready to raise $5-10 million. We're not even going to put you on the website. That's basically what it's turned into for the large guys. And then on the opposite end of the spectrum, there's folks like ourselves or First Round or True, and these are folks who are looking to go in and lead seed rounds, to be on the board, to kind of forge strategy, forge product, create customer intros, and help you build companies from kind of a very nascent stage. I think that type of investor profile looks a lot different. So there's nothing to say that a party round is better or worse than going straight institutional. It's just something to think about. So that's kind of one. And then in terms of the Series A crunch, I think it's just a pure numbers game, right? The top of the funnel has widened such that there are more angels, there's more individuals, there's more strategic money. I can't tell you how many foreign strategics have come into our office saying we want to play in Silicon Valley, who should we be investing in? And there's so much money frothing at the early stage that the venture community has not grown. It's stayed pretty flat. Actually, since 2000, the number of VC firms has decreased by 2/3. So you have institutional capital at the A and B round that's basically constrained, yet the top of the funnel at the seed is opening up with fresh capital. So by pure definition of mathematics, you're going to have a crunch. And so the institutional guys are now just measuring your Series A and B on a relative basis to the other folks out in the market. So if you're not top tier in your class or within your comp group, it's going to be tough to raise that A round.
So I can kind of add on to that, to Chris's point as far as the Series A crunch and what does it mean. It essentially is exactly that. It's just so many seed funds getting funded and kind of scrapping and fighting for a limited dollars, the same amount of dollars at the Series A level. So what does that mean? That typically means the bar is extremely higher. So we want to talk about Series C, Series A, Series B, whatever letter you want to put in front of it. It's all relative to where a company is in their life cycle, right? And so what we reference as a Series A company now is traditionally what used to be a Series B company. And then seed funds that are real true seed funds that come in and drive value, like Blumberg, they're essentially what used to be a Series A investor, but it's called the Series Seed investor. And so what's happening is there's a gap that's building between the founder at inception stage and to the point where they actually want to get out and when it's appropriate to get out and raise institutional money. And so that's where we see folks like AngelList coming in and playing a role. And I just say that there's a lot of capital out there, but it looks very different. There's different forms. Call it the traditional life cycle VCs versus the micro VCs versus friends and family and angel money. And so you need to take a deep, hard look at where you are on that cycle and understand that when you take money from an institutional firm at a seed round, there is strategic value there. And there's a price to pay for it also. And so my advice to anybody out there, and we can let the AngelList crowd give their perspective as well, is to kind of leverage, take as much time as you can and leverage platforms like that to get as far along in your life cycle before you start spending your time talking to institutional folks.
I'll give you one more setup of the dangers of raising institutional, having done this myself, and it worked out for us, but it's the signaling effect that I'm sure you have if you lead a seed round or if you raise from 4 brand name venture capital funds who just throw in call options. You basically can't talk to, you're not going to talk to any other funds by the time you get to the Series A. Like, you can explore any other opportunities, but the conversation will always come back to why Andreessen, who went into your seed round not investing, why Kleiner not investing. And so you are somewhat getting into bed with the brands that you raise the seed round from, because there is a huge signaling risk. So we decided to split the signaling risk by raising from many. I know other people build a very good relationship with just one. They take the risk of going with one, but they build the rapport so that they know that they'll kind of have the long-term vision with them. But that's why when a lot of friends come to me for introductions to our investors, I'm very happy to provide, and I do, but it's where AngelList, I've started to see kind of a huge kind of movement that direction, because you avoid this enormous signaling risk. And if you build an intrinsically kind of awesome company, you're going to get in front of these large bracket names come A rounds, and now AngelList has provided this kind of much de-risked somewhat way of raising kind of your first seed note convertible debt. So with that, AngelList, let's go.
Yeah, you guys said it all already. Yeah, I mean, I think to some extent AngelList is kind of feeding the flames on these trends that you guys are talking about. With, I mean, there's already a ton more really early stage capital available than there was 5 years ago, 10 years ago. And AngelList and platforms like it kind of make that even more immediately accessible. And with products like syndicates and Invest Online, if you guys have heard any of the news about those, suddenly like people with $1,000 can come in and get it on your seed round. And so it does mean that you can do these much more kind of open marketplace rounds really early on and stave off having to take maybe the unfavorable terms from a big institutional firm. And, you know, like you said, get more time to like really blow yourself out into something that's going to be at the top of the pack, or learn early on that isn't you. So yeah, I don't know. I think you guys touted AngelList enough, so I don't need to do it anymore. Yeah.
Well, I think what's interesting too is that entrepreneurs, you guys out there are aware as well, the times are changing and all these platforms are being built to kind of make access to that angel money a little bit more transparent and easier. So do you have any sort of like tips or trends that you've seen out of companies that the way they're utilizing the platform in effective ways
Yeah, I mean, the same sort of economics apply that always have, that you have a company with super strong traction and you know, a curve that's moving up, ideally for the hockey stick. But I think actually one of the interesting things that, from the entrepreneur's perspective, that AngelList enables outside of giving you access to capital, is you can do research on other companies in your space. Because pretty much every space is super overcrowded at this point, and you sort of see that going through any old market you pick. There's like 100 companies that are kind of doing the exact same thing. We've seen a lot of entrepreneurs like thank us for the ability to see, hey, my competitors were doing all this stuff, and I realized that we had this little gem that no one else was doing, and we could really focus on that. And see sort of from an investor doing that same research, what's their perspective going to be, and what are the things that are really going to stand out about us. So I think that's kind of the flip side of there's not only sort of a marketplace for funding, but there's also a marketplace for information that it kind of spouts up. It's almost kind of intrinsically a more valuable component, I think.
Yeah, it's really interesting, essentially being able to do your due diligence on yourself that an investor might be doing on you anyway.
Yeah.
Within the platform.
Yeah.
You mentioned the word traction, and I know that's a word that haunts founders a lot too, because there's this chicken and egg problem where you, in order to get money from investors, they want to see traction, but in order to get traction, you need a little bit of resources to accomplish that. So maybe Catherine and Anthony, you guys can speak to what examples you've seen in the market in terms of like being able to onboard clients and users with minimal outside resources, or what you saw when you were out there fundraising was most important.
Yeah, so I think what really worked for us fundraising-wise was joining, first of all, an accelerator, because that at Demo Day, that just put us in front of so many different types of investors all at one time. So we were in front of maybe 100 investors of every type, from strategics to traditional funds, top tier, second tier, whatever they're called, angels, so many different types. So that was really important, because it makes your ability to take on investment very scarce, if that makes sense. So it makes, you can only take a couple, and they know that, and they know that everyone in the room will probably want to invest in you if you're hot enough. So that was something that was really good, and I feel that with regards to your question on traction, I think that the companies at our demo day that had the most traction, that could show the highest level of users, getting more users or customers with as little resources as possible, were essentially the ones that are most interesting to investors. But it's something that we've struggled a lot with along the way. Investors keep asking for more traction. Get back to us when you have more traction. Well, thank you. When I have more traction, I won't want your money, because then I already have another investor. So I think the scarcity of your ability to take in investors is really important, and just to make it seem like, or to make it obvious to investors that other investors want to invest in you, so that there's just, this dynamics is really important to bring on, I think, in the fundraising process.
Yeah, so to fix the chicken and egg thing as an entrepreneur, I guess two things. One is, in today's world, to build an MVP, to hack, I'm not an engineer, but I can learn enough to hack something together or to outsource it, to test a couple of assumptions. You can do that for $5,000, $10,000 of, it's risky spend, but you can do that on the side before you decide to quit your day job, drop out of school. So I think in today's world, because software is so advanced, AWS, server capacity is incredible, it's actually quite easy to build an MVP, a minimal viable product, just to test an assumption and really prove it out. So I think that VCs, and you can contradict me on this, I think it's hard to go in with an idea, especially if you're a first-time entrepreneur. If you've kind of exited your last 4 startups, you probably can go in with an idea and raise a lot of money. This is my first company. It was impossible to go in with an idea. We went in with 3 to 6 months of really great data, of a couple of assumptions we were testing that a year and a half into our company in real estate, we still haven't actually launched, but it's very much our end game. So I guess the first lesson that I took was build an MVP, show 3 to 6 months of data, and that's normally a door opener. And the second one, which I think any entrepreneur would say, is just fake it till you make it. Everyone else out there they're pretending their platform is, we're a rental marketplace. So we need landlords posting on one side of our market, and we need renters searching on the other side, and ultimately we're building a world in which renters can walk into an open house and make an application and a binding offer on their iPhone for an apartment. And oh my god, like in the first 6 months, no one wants to talk to you. Like, of course they don't want to talk to you. Like, they're not interested. And so drive around to every one of their offices, like harass them. Like the creating the spark and the big bang, so to speak, of a startup. It's very rare that it will just take off on its own. So it's absolutely faking it till you can make it, and until the technology kicks in and makes what you've built scalable. The first 3 months are very unlikely to be technology enabled. They're much more likely to be entrepreneur enabled, and it's just 100% hustle. So one, build an MVP if you're raising money. It's possible to do on the side now, and two, just everything is hustleable. You can get there, and most tech plays don't start as a scalable tech play. They start as four people in a room just making endless cold calls until one market tips.
Yeah, I'll just add a couple things. One, if you're continuously hearing, come back to us when you have traction, you're either not talking to the right folks, or there's something else wrong and nobody wants to be upfront and transparent with you. We're early stage guys. We invest in a handful of folks in a whiteboard session. We've done that multiple times. We also do Series A, where we did a deal recently, a company called Yacht Pose, powering 50,000 e-commerce sites. So tremendous traction and unbelievable growth in 6 months. So we do both ends of the spectrum. What I would say is not everybody has that appetite to really do angel and seed investing, although they like to think they have that appetite. Because really it's about proving out an experiment, and it's hard to prove out an experiment when everybody's trying to just look for commercial traction. So those are contradictory. So I'd say pursue the right folks. Pursue folks that are interested in your industry, in your sector, that like the risk profile, and can ultimately add value.
So to just piggyback off of that statement, I think the general rule and what people's expectations are is when you meet with an investor, you go into pitch mode, or even when you have a pitch deck, you are trying to get it in the right hands so they can see it, and that's your opportunity to kind of officially, the first pitch opportunity you have to get a meeting. Well, to Chris's point, you also need to do your diligence, right? This is a two-way street. If they ultimately end up investing in you guys, you also need to do your diligence on them, make sure that they're the best partner. It's never good to just view it as, I just need capital and I'll take it from anybody. Maybe at the friends and family angel stage, where you just need capital to get to the MVP and get to a point where you could start having conversations, that's one thing. But when you start actually talking to some institutional investors who are actually going to actively take a strategic part in helping you grow your business, do your diligence and find out if they're the right folks. And if they're not, you should be spending your time talking to some other folks. And then one other point on traction, the term traction, if you were to ask people what they generally think traction is, I talk to entrepreneurs every day. A lot of times they say, oh, it's revenue or users. Find out what's applicable to your respective business to essentially be able to prove something and highlight that as traction as you go out and meet with investors. I see a lot of founders that are scared they say, I don't know how to address the traction issue because we don't have any revenues. Well, maybe that is what traction, the relevant traction for you guys, but really dig into it and find out and make sure it is.
Yeah, one thing I'll add to that is that at seed stage, I think what I said hopefully applies. At the next round of capital, which slightly goes beyond the kind of title of the talk, is actually the traction is irrelevant, it's momentum. There is no absolute number, and again, please contradict me, this is the entrepreneur's opinion of how investors saw us when we were raising a Series A. there was no absolute number that we had to hit. So, we're a rental company. We control over 20% of the rental inventory in major US markets. And as an absolute number, that sounds great, but it didn't matter. What mattered is that for the 7 weeks prior to our Series A board meetings, we grew that number kind of 20% week on week. And it's just, I don't think investors would put this out there, because otherwise people would just spike their numbers for the 2 months before they raise money. But momentum's everything for investors looking for kind of 10, 20, 30x their money. So when in the absence of a natural tipping point under traction, because who the hell knows what an absolute number is that looks good in any market, momentum is your best friend in the absence of kind of a grey area around an absolute number. So we were very focused into the Series A meetings and just growing 2 or 3 core kind of KPIs in the run-ups that we've continued to grow since. But it just massively helps your story if this is a growth story, not just we've hit this number, now we're going to chill. It's momentum is everything.
I'll just add one more point to that. That's exactly right. And we tell our portfolio companies it's all about momentum all the time. And not just momentum and what you can measure in the KPIs, but you're adding people to the team, you're pushing code, you're adding features. It's all about just moving every day, moving the bar further and further. And that's what investors are for. I'll be the first to admit the industry is very sheepish. People kind of follow in herds. And so to the extent you can get anyone excited, there'll be a line of VCs behind it. And the way to do that is to show momentum in every aspect of the business.